Hey everyone, welcome back to Corporate Decoder, the place where we decode the secrets hidden within those big corporate reports. And let me tell you, if this latest filing from FutureCrest Acquisition Corp is a bit more complex than usual, it's like trying to solve a puzzle with half the pieces missing, but that's where we come in. In this video, we're diving deep into FutureCrest Acquisition Corp's S-1 filing, a document that's essentially laying the groundwork for their big public debut. Think of it as the pre-game show before the main event, a SPAC, a special purpose acquisition company, looking for a company to merge with. We'll break down what this means for investors, what exciting and maybe a little scary risks they're flagging, and what the leadership team is planning. Alright, so FutureCrest Acquisition Corp is filing with the SEC. This is a standard step for any company going public. It's like telling the world, here we are and here's everything you need to know before you invest. The company name is FutureCrest Acquisition Corp. Sounds pretty forward-thinking, right? They are a blank check company, which means they don't have any actual business operations yet. Their whole purpose is to raise money from the public, then go out and find a private company to merge with. They formed in June of 2025 in the Cayman Islands. This filing is for their initial public offering, meaning they're selling shares to the public for the very first time. They're offering 25 million units, and each unit is made up of one Class A ordinary share and a quarter of a redeemable warrant. The price is $10 per unit. Now, about those warrants, each whole warrant gives you the right to buy one Class A share for $11.50. But there's a catch: you only get warrants in whole numbers, and since each unit only has a quarter of a warrant, you'd need to buy at least 4 units to even get one whole warrant. This is a bit different from other SPACs, and they mention it could make them seem like a more attractive partner to the company they eventually acquire. Their sponsor, FutureCrest Acquisition Sponsor LLC, along with Cantor Fitzgerald & Co., the main underwriter, are buying about 3.5 million private placement warrants. These are bought separately from the public offering, and it's a way for them to also invest in the company. This is where it gets interesting. The sponsor bought a huge chunk of Class B shares, over 7 million of them, for a tiny amount of money, just $25,000. That's less than half a cent per share. This is a common practice for SPAC sponsors as their incentive to get a deal done. But it also means there's a lot of dilution for public shareholders. They explain that these Class B shares will convert into Class A shares later, and because they were acquired so cheaply, public shareholders will face significant dilution. They even mention that the founders could make a killing even if the stock price drops after the merger. Even the directors and officers are getting in on the founder shares indirectly through their stake in the sponsor. Another sign of how concentrated ownership might be. This is a big one. Some of the management team have duties to other companies. This means they might have to present business opportunities to those other companies before they present them to FutureCrest. That's a potential conflict of interest they're clearly highlighting. They have a ticking clock, 24 months to find a company and merge. If they don't, they have to liquidate and return the money to investors. This pressure can sometimes lead to rushed deals. They plan to list on NASDAQ under the ticker FCRSU. That's the symbol for the units. Once the shares and warrants start trading separately, the tickers will change to FCRS and FCRSW respectively. The table here shows the money side of things. They're raising $250 million from selling these units. After taking out underwriting fees and other costs, they'll get about $35 million for the company itself, before putting a large chunk into that trust account. A massive $250 million, or even more if they sell extra units, is going straight into a trust account in the US. This is standard for SPACs, providing security for investors. This table shows dilution, which is super important. It compares the $10 per share, especially if a lot of people redeem their shares. In the maximum redemption scenario, the NTBV per share after the offering is negative 1.53, meaning the price paid is way higher than the tangible value of the company's assets. This highlights the dilution from the sponsor's cheap shares and the warrants. This is a recurring theme, conflicts of interest. Because they're invested in the company and stand to make a profit upon its sale, their decisions might not always align with what's best for public shareholders. They're trying to be very transparent about this. Let's jump into the table of contents to see what's next. They've dedicated a whole section to sponsor information, which makes sense given the potential conflicts. Again, they remind us they are a blank check company with no real business yet, just the plan to buy one. The CEO is Thomas Lee, also a big name in financial strategy, founder of Fundstrat Global Advisors. The CFO is Chi Sang, who has a strong finance background with HSBC, and on the buy side, the director nominees like Eric Semler, Seth Gins, and Sam Engelbart bring a mix of investment, tech, and media experience. They have advisors too, like Gaspard Dedrozzi, a fintech entrepreneur, and Dr. Oscar Salazar, the founding CTO of Uber, a very experienced team, no doubt. Their name, FutureCrest, is tied to their investment thesis: AI, digital assets, fintech, robotics, and communications. They see massive growth in these areas. They're banking on AI's explosive growth, projecting a CAGR of nearly 36%, which is huge. This is the core of their strategy. Their acquisition criteria? They're looking for high growth companies that are disrupting big markets with innovative tech and strong management. Essentially, they want to find the next big thing. A crucial point for investors: if they don't find a target and merge within 24 months, public shareholders get their money back from the trust account. It's essentially a promise to return your investment if they fail. The units themselves will be tradable, but the shares and warrants within them will start trading separately about 52 days after the IPO, which is standard. They're an emerging growth company, which means they get some relaxed reporting rules. This can be good for the company, but might mean less transparency for investors. Let's look at the money in the underwriting table. The public offering price is $10 per unit. The underwriters get a commission of dollars per 60 Ks per unit, meaning the company gets 9 tons, 40 cents per unit before other expenses. That's a significant chunk going to the underwriters. Remember that trust account, $250 million split into $10 per unit is going into it. This is the money that would be returned to investors if they don't find a deal. This dilution table is key. It shows that out of pocket you're paying $10 per share, but the book value per share is much lower. In the worst case redemption scenario, the net tangible book value is actually negative 153 fins per share after considering all the shares and redemptions. This massive negative book value shows how much dilution there is from the sponsor's cheap founder shares and warrants, impacting the value per share after considering all the shares and redemptions. This massive negative book value shows how much dilution there is from the sponsor's cheap founder shares and warrants, impacting the value per share. Back to conflicts of interest. They own a lot of the company's early shares and warrants for very little money, creating a strong incentive to complete any deal, even if it's not the best one for public shareholders. They could profit even if the stock tanks post-merger. Let's navigate through the rest of the document by checking out the table of contents. The summary section is crucial for a quick overview. They reiterate the sponsor's role and the potential conflicts. They're a blank check company from the Cayman Islands, formed to buy another business. No existing operations. Thomas Lee, the CEO, is a well-known financial strategist. The CFO, Chi Sang, has a strong finance background. The directors bring diverse expertise, including in tech and investment. They have advisors too, like Gaspard Dedrozzi and Dr. Oscar Salazar, who have experience in fintech and tech scaling, respectively. Their investment focus is on AI, fintech, digital assets, robotics, and communications, sectors they believe are poised for massive future growth. They highlight the huge projected growth in AI, touching on fintech, business intelligence, productivity software, and digital health. These are the areas they're targeting. Their acquisition strategy centers on finding disruptive, high-growth companies with strong management and a clear path to profitability. This is the investor protection clause. If they don't find a company to merge with within 24 months, investors get their money back from that trust account. They're aiming for a Nasdaq listing, which is a positive sign for liquidity and visibility. The underwriting table shows that for every $10 unit sold, $60 underwriters as a commission. The company receives 920 receipts before accounting for other offering expenses. A huge portion of the money raised, $250 million, is being parked in a trust account. This is meant to safeguard investor capital until a deal is found. The dilution table here is stark. It shows that after the offering, the net tangible book value per share can be negative, especially if many shareholders redeem their shares. This is primarily due to the sponsor's founder shares being bought for almost nothing. It means the initial public investors are paying a premium over current tangible asset value. They're highlighting potential conflicts of interest because the sponsor and management own founder shares for a fraction of a cent and private placement warrants. This gives them a powerful incentive to complete a deal, as their profit could be substantial even if the acquired company doesn't perform well. Looking at the capitalization table, we see how the company's finances will be structured post-offering. It shows how much debt and equity they plan to have. This actual column shows figures from before the IPO. The as adjusted column reflects the impact of the IPO. The note payable to a related party, which is a loan from the sponsor, gets wiped out after the IPO as it's repaid with offering proceeds. Now let's dig into the management's discussion and analysis. This is where the company explains its current situation and future plans. They restate that they are a blank check company formed to buy another business. No current operations, no revenue. How will they pay for the acquisition? They list a bunch of ways from using cash from this offering, issuing shares, taking on debt, or a mix. Flexibility is key here. This is a warning about dilution. If they issue a lot of new shares to acquire a company, existing shareholders will own smaller pieces of the pie. This dilution effect could be amplified by the founder shares anti-dilution rights. Looking at the statement of operations, we see a net loss of about $17,000. This is basically the cost of getting the company set up and ready for this IPO. No revenue yet, which is expected for a SPAC. The auditors, Withum Smith plus Brown PC, confirmed that the financial statements they reviewed fairly represent the company's financial position. They are independent and followed our PCAOB standards. The balance sheet at June 30, 2025 shows minimal assets, mainly deferred offering costs. Liabilities are also small, primarily accrued expenses, and a small loan from the sponsor. Shareholders' equity is almost zero because the real money from the IPO hasn't come in yet. The statement of cash flows shows very little cash movement, consistent with a company still in its formation phase. All the costs incurred so far were covered by the sponsor's initial investment and a small loan. This section explains the company's structure and purpose. They are a SPAC formed to find and merge with a business. They haven't picked a target yet. The sponsor is FutureCrest Acquisition Sponsor LLC, and they are crucial to its setup. The company is planning an IPO of units, shares, and warrants to raise capital. A key detail here is that $10 per unit sold in the IPO will go into a trust account. This is the money meant to secure investors' capital. This agreement for the sponsor and management is important. They're waiving their right to redeem their shares for cash if the deal doesn't happen. They'll only get their money back if they hold public shares, not their founder shares in case of liquidation. In the shareholders' equity notes, we see the details about the Class B founder shares given to the sponsor for a nominal amount. The number of these shares is tied to the IPO size, ensuring the sponsor maintains a 20% stake post-offering. The registration rights agreement gives the sponsor and certain warrant holders the right to have their shares registered for public sale, meaning they can sell their shares after the IPO. This could increase the supply of shares on the market. Cantor Fitzgerald & Co. is the main underwriter. They're helping to sell the securities to the public. This section discusses the underwriter's role in managing the stock price, including stabilizing it if needed. They can buy back shares or sell short to keep the price from dropping too much right after the IPO. Cantor Fitzgerald isn't just underwriting, they're also buying over 1 million private placement warrants. This is another investment from them, and these warrants are also considered part of their compensation. Finally, the signatures of the CEO Thomas Lee and CFO Chi Tsang indicate their approval of this filing. It means the company is officially submitting this to the SEC. Now, looking at these numbers and the whole setup, FutureCrest Acquisition Corp is a carefully constructed SPAC designed to attract a specific type of target company in the tech and digital space. The leadership team is experienced and they've laid out a clear strategy. However, the potential conflicts of interest highlighted by the sponsor's cheap founder shares and the significant dilution shown in the financial tables are definite red flags. The company's success hinges entirely on finding the right acquisition target within the strict 24-month deadline and then making that company thrive. It's a high-risk, high-reward scenario typical of SPACs, but with these specific conflicts, investors need to be extra watchful. Alright, that's our breakdown of FutureCrest Acquisition Corp's S-1 filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out our Discord server in the description below where we chat about these filings and much more. Thanks for watching. See you next time.